Good morning, learners. Welcome to the course of Digital Finance. This is Sarita Yadav, Assistant Professor in Management Education and Research Institute, Delhi. Today we are here to discuss about landscape of Fintech. Close your eyes for a moment and imagine a world just a few decades ago, before smartphones, before internet, before instant payments. Back then, banking means standing in long queues, waiting days for checks to clear, and filling out endless paperwork for a simple loan. Finance was actually a fortress controlled by few powerful institutions, and accessing it was not easy for everyone. However, as the world entered the digital age, a quiet revolution began to take shape. Now fast forward to today, tap your phone and your bills are paid. Swipe a card and money travels across the globe in seconds. Need a loan? An app analyzes your creditworthiness in real time and approves it within a minute. Actually, welcome to the world of Fintech, where finance meets technology, transforming how we interact with money and reshaping economies. So in simple terms, we can define financial technology or Fintech as an integration of technology with financial services to improve and automate the delivery and use of financial services. Over the past decades, Fintech has transformed from niche industry to a multi-billion-dollar sector, reshaping how individuals and business interact with financial institutions. Fintech encompasses a wide range of services, including mobile payments, online lending, insurance technology, wealth management platforms, and blockchain-based solutions. So, this revolution would transform not only how money moves, but also how trust, efficiency, and inclusivity are built into the financial system. So, this lecture is not just about numbers or financial jargons, it's about a revolution. How a once rigid, slow-moving system has become agile, inclusive, and smarter. We will journey through the origin of Fintech, explore its key players, and discover how it's making financial services accessible to billions, even those who were once left out of the system. The protagonist in this tale is not a single entity, but a collective force which include innovators, dreamers, and technologists who dare to change the traditional financial system. Their story unfolds across multiple eras, which marked by groundbreaking advancements and paradigm shifts. So, story of Fintech began in the mid of 19th century, a time when communication across continents was slow as sailing ship. Yet, in 1866, something extraordinary happened. The first successful transatlantic telegraph cable was laid, and the financial world took a leap forward. Suddenly, information could be transmitted across oceans in minutes instead of weeks. So, let's begin with evolution in Fintech. Fintech 1.0, the dawn of financial technology. In this early chapter of Fintech, the seed of transformation were sown. Banks began using telegraph services with wire transfers, making it possible to send money across long distance faster than ever before. Imagine the relief of merchants and traders who no longer had to rely solely on physical cash deliveries. Later in the 1950s, the humble credit card was born. This small piece of plastic was a game changer, allowing people to make purchases without carrying cash. By the 1960s, banks were investing in mainframe computers, giant machines that could process thousands of transactions much faster than humans. Finance was entering the machine age. This period was characterized by mechanical and electronic innovation, but the real transformation was yet to come, the digital awakening that redefined finance forever. Fintech 2.0 came in picture, which was called the digital awakening. Fast forward of 1970 was a time of disco music, bell bottoms, and the rise of digital technology. In this era, ATMs made their debut, bringing 24/7 banking services to people for the first time. Picture a banker who never sleeps, always ready to dispense cash. The 1980 brought electronic trading system to stock exchanges, making buying and selling shares faster and more efficient. Then came the 1990, an era when the internet began to weave its web around the world. Banks embraced online banking, enabling customers to check their balances and conduct transactions from the comfort of their homes. Global payment networks like Visa, MasterCard, SWIFT connected the financial world, ensuring that people could send and receive money across borders with ease. While traditional banks led this transformation, a new wave of innovation was waiting in the wings. These pioneers would take finances into uncharted territory, fueled by the rise of smartphones and a growing dissatisfaction with legacy system. Then Fintech 3.0, the new era, the startup arrived. The year 2008 was turning point for Fintech. As the world reeled from the financial crisis, a new generation of innovators saw an opportunity to disrupt the startup queue. Enter Fintech startups, nimble tech-savvy players who were unburdened by legacy system. Mobile payments became the new normal thing thanks to the proliferation of smartphones. Imagine paying for a cup of coffee with a simple tap on your phone, a dream that was not reality. Peer-to-peer lending. The platform connected borrowers directly with individual lenders, cutting out of the middleman. And then there was Bitcoin, the mysterious digital currency that promised a world without banks. Meanwhile, robo-advisors began offering automated investment services, democratizing wealth management for the masses. In this era, venture capitalists played a crucial role, providing funding to bold startups willing to take risks. Government too began to notice introducing regulatory frameworks that encourage innovations while safeguarding consumer interest. Then in advancement, Fintech 4.0, which was called integration and regulation. As we move in the present day, the Fintech world finds itself at a crossroad. Traditional banks, once wary of these upstarts, are now eager to collaborate. Open banking initiatives have forced banks to share customers' data with third-party providers, fostering innovation. Embedded finance, where financial services are seamlessly integrated into non-financial platform, is becoming commonplace. Picture a world where you can get a loan while shopping online, or where your favorite social media app doubles as your bank. This is the reality of Fintech 4.0, where financial services are embedded into the digital experiences people use every day. Meanwhile, decentralization finance platforms are challenging the very notion of financial intermediaries. Imagine a world where lending, borrowing, trading happen without banks, government only by smart contracts on blockchain. This is the reality of today's fintech landscape. Now let's see the force deriving fintech. What are the different forces which are driving the fintech? So every great story has forces that propel to forward. In the case of fintech, these forces are technological advancement, changing consumer preferences, regulatory frameworks, and cues for financial inclusion. So first we will see technological advancements. The heroes of this tale are the technologies that have enabled fintech to thrive. Artificial intelligence acts as the wise guide, helping companies make a better decision and detect fraud. Blockchain, with its transparent and secure ledger, is like the magical shield that ensures trust in digital transactions. Meanwhile, cloud computing provides the infrastructure, and big data analytics offers the map that helps fintech companies navigate the complex world of finance. Second one is changing consumer preferences. Once upon a time, people accepted the slow pace of traditional banking, but as technology advanced, they began to expect more and more speed, more convenience, and more transparency. Fintech stepped into to meet these expectations, offering faster services, lower fees, and greater control over financial decisions. Then third came regulatory reforms. In any good story, there are gatekeepers, those who ensure that order is maintained. In fintech, these gatekeepers are the regulators. Recognizing the potential of fintech to drive economic growth, many governments have introduced regulatory sandbox where new ideas can be tested safely. Open banking regulations have also played a crucial role, allowing fintech companies to access banking data and offer innovative services. And last one is financial inclusion, including the people who are not part of the financial institutions, are not part of the organized financial market. So fintech has risen to the challenge, offering digital wallets, micro loans, and mobile-based financial services that bring the unbanked into the financial fold. So these were the driving force of fintech. Now we will move on to the many phases of fintech. Like any epic tale, the story of fintech has many characters, each with its own role to play. These characters are the different segments of fintech, from the digital payments and lending to wealth management and blockchain. First one is digital payment, the speedy messenger. In the fintech story, digital payments are the speedy messengers ensuring that money moves quickly and securely. Companies like PayPal, Alipay, Google Pay have made it possible to send money across the globe with just few clicks. Then next one is digital lending, the bridge builder. Digital lending platforms have built bridges where traditional banks saw walls. By leveraging alternative data and AI-driven credit scoring, these platforms offer loans to those who were previously considered unbankable. Third one is wealth management, the wise advisor. Robo-advisors have taken on the role of the wise advisors, offering personalized investment advice at a fraction of the cost of traditional wealth managers. Then InsurTech, the protector. InsurTech are the protectors. InsurTech companies are the protector of this tail, using technology to offer better, more personalized insurance products. Then next one, which is a more important one, blockchain and cryptocurrency, and these are called the rebel. Blockchain technology and cryptocurrencies are the rebel of the story, challenging the traditional order and offering decentralized alternatives. And next is RegTech, the law keeper. When the rebel is there, then the law keeper is also there. In any great saga, there are law keepers who ensure the rules are followed. RegTech solutions help financial institutions comply with regulations efficiently, ensuring that fintech innovations remain within the bounds of the law. Now, we will see the challenges ahead. Every story has its obstacles, and fintech is no exception actually. So regulatory uncertainty, cybersecurity, risk-intense competition, and scalability issues are some of the challenges that fintech must overcome on its journey. Now we will see the evolution of fintech in India, a journey through time. Once upon a time, in the early days of independent India, the financial system was like a slow-moving cart, heavily dependent on manual processes and paperwork. Banks operated in a traditional manner, and financial transactions were mostly carried out in person actually. People stood in a long queues for basic services, and the concept of digital banking was far beyond anyone's imagination. However, the winds of change began to blow in the late 1980s, when technology gently knocked on the doors of the Indian banking system. Banks started to introduce computerization in their branches. This was a small but a significant step towards improving efficiency and reducing human errors. It was during this period that seeds of fintech, though not yet called by the name fintech, but yes, the seed was planted. So we will see the evolution of fintech in India by different phases. So phase 1, the dawn of change, which was from 1980s to 1990. The story began to unfold in earnest when the Narsimham Committee came into the picture in 1991, recommending sweeping reforms in the banking sector. These reforms acted as the much needed fertilizer for the growth of technology in financial services. Banks were encouraged to embrace modernization, and soon the first ATMs sprouted across major cities, allowing people to withdraw money without visiting a bank counter. By the late 1990s, a few forward-thinking banks introduced core banking solution, a technology that connected all branches of a bank, making it possible for customers to conduct transactions from any branch. This was revolutionary because it removed the need for customers to visit their home branch for services. Meanwhile, the government and the Reserve Bank of India continued to water the sapling of financial technology, hoping it would someday grow into strong tree that could bear the fruits of convenience and accessibility. In phase 2, which is called the early blossoms, 2000s. By the early 2000s, the Indian financial system was transforming rapidly. A new generation of private banks, led by pioneers like HDFC Bank, ICICI Bank, and Axis Bank, began to push the boundaries of technology. These banks introduced internet banking and mobile banking, which allowed people to access their accounts from the comfort of their homes. In 2004, the RBI introduced the National Electronic Fund Transfer, which is called NEFT system, making it possible for the customers to transfer money electronically between banks. Soon after, Real-Time Gross Settlement (RTGS) was launched, enabling a real-time high-value money transfers. These were the first real signs that India was on the path toward digital finance revolution. As the decade progressed, credit cards, debit cards, and online payments gateway became common. People began to trust digital transactions. Though cash still ruled the economy, the sapling of fintech was now growing stronger, nourished by the increasing availability of the internet and mobile phones. In phase 3, which is called the Fintech Awakening, it was the era of 2010 to 2016. The story saw the birth of fintech startups, small agile companies that sought to bring financial services to every corner of the country. Companies like Paytm, Mobivic, Freecharge introduced digital wallets, making it easy for people to make payments using their mobile phones. Meanwhile, the government launched the Aadhaar project, which gave every Indian a unique digital identity. This initiative, coupled with introduction of eKYC, which is called Know Your Customer, processes enable fintech companies to onboard customers quickly and securely. In 2010, the Immediate Payment Services, which is called IMPS, was launched by NPCI, allowing instant bank-to-bank transfer 24:7. This marked a new era of convenience as people could now send money with just a few clicks. By now, the tree of fintech had begun to bear fruit, with more and more people adopting digital payment solutions. Yet, a major event was about to occur that would forever change the financial landscape of India, which was phase 4. The phase 4, which is called the Digital Revolution, 2016 to 2020. In November 2016, a thunderstorm swept through the country in the forms of demonetization. The government withdrew ₹500 and ₹1,000 notes overnight, pushing millions of people toward cashless alternatives. This event acted as a catalyst, accelerating the adoption of digital payment like never before. Companies like Payment saw an unprecedented surge in users as people flocked to digital wallets to manage their daily expenses. Around the same time, the NPCI launched Unified Payment Interface, which is called UPI, a game-changing innovation that allowed instant money transfer using mobile apps. Apps like Google Pay, PhonePe, and Bheem became 1,000 names, making UPI the most preferred mode of payment across the country. The government also introduced Bharat QR and the Bheem app to further promote cashless transactions. Digital lending platforms like Lending Cart and insurtech companies like Policy Bazaar started gaining tractions, offering loans and insurance with minimum paperwork. Then in phase 5, which is called the new age of fintech from 2020 to till date, as the world grappled with COVID-19 pandemic, digital financial services became more important than ever. People relied on fintech for contactless payment, online banking, and digital lending, accelerating the sector's growth. A new generation of neobanks, fully digital banks with no physical branches, began to emerge. Companies like Jupiter, Neo, Razorpay, they offer the seamless tech-driven banking, we can say. Meanwhile, innovation in buy now, pay later, which is called BNPL services, led by the startup like Just Money and Simple, changed the way people approach credit. The government also played a pivotal role in supporting fintech growth by launching initiatives like India Stack, which provide API for digital identity for the Aadhaar, digital payments UPI, and digital documents, which is called DigiLocker, that account aggregator framework allowing individuals to securely share their financial data with service providers to access better financial product. By 2020-23, India had become a global fintech leader with over 23 fintech unicorns companies valued at over $1 billion. So if we see the future of fintech in India, today as the fintech tree stands tall, it continues to grow and spread its branches, offering shades to millions of people across the country. With the innovations in blockchain, artificial intelligence and digital currencies on the horizon, the future of fintech in India looks brighter than ever. As India marches ahead on its digital journey, one thing is certain, this is just the beginning of the story that promises to be both exciting and transformative. So now we will see that what had been the trigger point for the emergence of fintech. So first one is the social economic, the need for financial transformation. The origin of fintech in India can be linked to the broader social economic challenges faced by the country. In the early decades following independence, India's financial system was primarily focused on urban populations, leaving a significant portion of the rural population unbanked. So despite the expansion of banking services through nationalization in the 1960s and 1970s, large segment of population of India still lacked access to the basic financial services. This created a fertile ground for innovation when technology began to emerge as a viable solution to bridge the gap. So second that trigger point had been we can say the first spark of technological disruption in banking. That was the technological disruption actually. The real shift began in the late 1990 and early 2000 when private banks entered the market. Unlike their public sector counterparts, these banks were quick to adopt cutting-edge technologies to gain a competitive advantage. This period saw the introduction of digital ledger systems which replaced cumbersome manual record keeping, then automated teller machines which we had discussed earlier as well, which introduced round the clock cash withdrawal facilities, then online banking portals which enable customers to conduct transactions remotely. So while these innovations were initially limited to urban users, they planted the seeds of financial digitization, proving that technology could improve access to financial services. The next trigger point had been a national priority, which is financial inclusion and much needed in India, and digital identity. So one of the critical turning point in India's fintech journey was the recognition by policymakers that financial inclusion was key to economic development. This led the launch of several government-led initiatives aimed at improving financial access. So we can say one of them which would have been a revolution in financial inclusion, that was Pradhan Mantri Jan Dhan Yojana, which is called PMJDY, launched in 2014. This program sought to provide every household with a bank account. It laid the groundwork for millions of people to enter the formal financial system, creating a vast untapped market for fintech solution. Second one, the Aadhaar, the introduction of Aadhaar. The introduction of Aadhaar provided every Indian with a unique digital identity, which we again had discussed earlier as well, which provides seamless financial services, reducing the cost and time required for KYC processes. Then direct benefit transfer. To eliminate leakage in subsidy distribution, the government launched DBT, which directly credited benefit into the beneficiary's bank account. This required robust digital payment system, further fueling fintech growth. And next one is collaborative innovation, the role of public and private players. So fintech in India owes much of its early success to the unique collaboration between public and private players. While government institutions like the Reserve Bank of India and NPCI provided the regulatory framework and digital infrastructure, private startup innovated on top of these platforms. So some key milestones included into it. One of that, again we had discussed, that IMPS, which was launched in 2010, which enabled instant interbank transfer. Then we had discussed UPI as well, which had been the game changer and which democratized digital payment banking. So we can say that in financial inclusion, these fintech services or this digitization has played a very important role. Then another help was entrepreneurial boom. The fintech startups entered into the scene. So the early 2010 witnessed the emergence of several fintech startups that sought to address specific pinpoints on the financial system. So unlike traditional financial institutions, these startups leverage technology to create user-friendly, cost-effective solutions. So some of the notable examples we can take. That one is the Paytm. Paytm, totally revolutionized the online banking systems, or through the UPI payments, or through QR code payments. Then Mobivic, which introduced digital wallets to help users store and transact money without needing a bank account. Then for the insurance, Policy Bazaar, again we are going to explain this further. Also we are going to explain in InsurTech. So this entrepreneurial wave was backed by a surge in venture capital investments with both domestic and international investors keen to capitalize on India's growing fintech market. Then very important we can say trigger point had been, that is cultural shift, the acceptance of digital finance. The country like India, while the technology was ready, fintech adoption truly took off when a cultural shift occurred in how people perceived financial services. Several factors actually contributed to this for the adoption of fintech services and technology. One was the smartphone penetration, with affordable smartphones and low cost internet provided by the players like Reliance Jio. Even rural populations could access digital platforms. Then second one was the trust in digital platforms. Fintech companies invested heavily in building trust through robust customer support, transparent processes, and partnership with established financial institutions. Then government also pushed for a cashless economy. Post demonetization in 2016, the government aggressively promoted digital payments as means to reduce cash dependency, boost transparency, and curb corruption. So that's how it helped. Then financial social impact, empowering the undeserved, also played an important role. So beyond convenience, fintech has had a profound social impact in India. So by providing easy access to financial services, it has empowered millions of undeserved individuals and small businesses. Some notable impacts of this had been like micro loans for small entrepreneurs. Digital lending platforms have provided quick collateral-free loans to small business owners, enabling them to expand their operations. Then affordable insurance. InsurTech platforms have made insurance accessible to low-income groups, protecting them from financial shocks. Then saving and investment platforms like fintech startups have simplified investing, encouraging a culture of saving among young generations. So that's how we can say there had been some triggering point that fintech came into the existence, and now it is growing, and now it is being welcomed by the people of India, and people are embracing this with their smartphones or by using the different fintech services. So this is growing with a very fast pace, we can say, and people from India, people from the rural background of India, they are also have started, embracing this technology through taking the through making the online payments, or through taking the help of the money transfer, or we can say through taking micro loan, or we can say microfinance, or opening their banking account, or doing the online payments and everything. So that's how fintech is enabling people to make their payments, to transfer their money, and to invest their money, and we can say to lend the money, or to borrow the money. So in so many ways fintech is helping people and making their life easy. So that's all for today. Thank you so much.